Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to financing strategies, taking into consideration permanent and temporary assets as we go through our financing strategies. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to be considering our financing options of the assets, remembering our accounting equation, which is assets equal liabilities plus equity. So whatever assets we have to be financing them with liabilities or equity. We have the assets in general because we need them in order to get a return on them on the income statement to generate sales. We're going to be considering the financing of them with debt in this case and breaking out that debt into short-term and long-term debt. As we do so, it's useful to then break out our assets into the components of assets, including permanent current assets, and we have the total current assets here, and then we can figure out what the temporary current assets will be. Now, permanent current assets is something that you will not find, or temporary current assets on the financial statements, but it can be a useful tool when trying to break out your debt financing between short-term debt and long-term debt, because the temporary assets or the permanent current assets, which seems like counter terms there because it's permanent and a current asset. Current assets means it's going to turn over, shortly. It's fairly liquid, things like accounts receivable or things like inventory. But as they turn over, they will be replaced by new sales, increasing the receivables back up again and resulting in the need for more inventory. So we can think of the permanent current assets as a kind of a base, like it's always churning, but the number is going to stay relatively fixed or not go below a certain amount, which we can consider permanent. And in the temporary items, we might have a spike in the current assets for whatever reason, possibly a spike in sales, which increases a spike in receivables and possibly inventory, for example, that we would expect then to go back down later on when the sales go back down, and that ripples through to the receivables as well. So we want to take that into consideration, then consider our financing. When we consider the financing, we're typically thinking about short-term and long-term financing. And oftentimes, if we can break out our short-term needs, we might be able to get a short-term loan, which could have more benefits than trying to get a longer-term loan. We could kind of measure how long of a loan we need for the different asset structures that we have. So if we're picking up the short-term loan, we might be able to get a better rate for the short-term loan and not lock ourselves in possibly to a longer-term loan that we, maybe being required to pay the interest or whatever, depending on the terms of the loan and the long-term loan. And then on the long-term loan, if we need something for a longer period of time, it might be a longer rate or a higher rate to do so, but possibly we can lock down the rate on the long-term loan. That usually results in the rate being higher if you're going to lock it down for a longer period of time. So that's often going to be our needs here. So if we can think about how long we need the loan, we might be able to take out a couple different loans to meet the needs that we think are going to be taking place. So we're going to have a plan to finance all fixed assets and half of the permanent current assets with long-term financing, and the rest will be financed with short-term financing. Long-term financing rate 12%, short-term rate 8%, and then the earnings before interest and taxes are going to be $530,000, tax rate 35%. We're going to calculate the earnings after taxes and interest. So let's take a look at that. So to do this, first we're going to be calculating or figuring the temporary current assets. Notice they didn't give us that. They gave us the current assets and then the permanent current assets. So we can take those two numbers and figure out the temporary current assets. So the total current assets, this would be what would be on the balance sheet in the current assets section, the 990. Then the permanent current assets are going to be the ones that we're going to say, hey, this is the baseline of the current assets. They churn around all the time, but they don't go below this baseline level. Therefore, in that sense, they are then permanent. We're going to say permanent. The 460,000, let's put an underline there, home tab font group, and underline that one. And that means that the temporary, I'm going to type this in, temporary current assets are then going to be equal to the 990 minus the 460 or the 530. So then we can apply out our plan, and we could be more or less aggressive, but we can do so mindfully based on what we think our short-term and long-term needs. We don't have to line up our loan, of course, simply to what we believe are going to be the permanent and temporary type of accounts, but we can, measure our plan in accordance and get a better understanding of it with that information. So now we're going to say given that information, we're going to plan to finance all the fixed assets and half of the permanent current assets with long-term financing. So we're going to say, obviously, the fixed assets, property, plant, and equipment, those things that we purchased are permanent. We're going to finance those with long-term financing. You would expect that to be the case if you're going to have some kind of breakout. And then we're going to finance some of the permanent current assets. So we're going to see which are the permanent assets. Now, you think we might want to finance all of them, but we're going to say we're going to be a bit more aggressive and say, I'm just going to take some of those permanent asset ones and finance them with the long-term. And then the rest, we're going to be financing with the short-term loan and taking a little bit more risk in doing so. Okay, so we're going to be then calculating the interest on it. Long-term interest expense, colon, is what we're going to calculate here. We're going to be then picking up the long-term loan that we're going to be taking out. And that, they said, the long-term is going to be all the fixed costs and half of the permanent current assets. So that's going to be all. This is going to be all of the fixed assets, and then we're going to be taking half of the permanent current assets. So then I'm going to say plus the $460,000, but I only want half of that, so I'm going to take times 0.5 or 50%. We don't need brackets because of the order of operations. It'll do the multiplication before the addition, but it might make sense to kind of see the brackets here. We're going to take half of that number and then add like the other number to it. And then we're going to say there's the $960,000. The rate then, let's pick up the rate that we're going to be applying out here. That's going to be the 12%. 12%, the longer term rate, because it's going to be the longer term financing. Let's percentify this cell by going up to the Home tab, number group, percentify it. And then we're going to go to the Home tab, font group, and underline it. And then we're going to be multiplying that out, and that's going to give us the long-term interest expense. And then that's going to be in our outer column. This is going to be equal to the $960,000 times the 12% for the $115,200. Let's go ahead and format this now, selecting these three cells. Home tab, alignment group, increase the indenting. I'm going to increase the indenting here one more time. Home tab, alignment group, increase the indenting one more time. Now we want the short-term interest expense, colon. And that's going to be the short-term loan that we need. And this is going to be the total assets minus the current assets that we had. Now, this is a little bit tricky because they gave us the current assets and then the permanent assets and the fixed assets. The permanent assets include the current assets include the permanent current assets in it. So the two amounts that would be on the balance sheet would be the current assets and the fixed assets, giving us our total assets. So we would then say our total assets would be equal to this current assets plus the fixed assets. That would be total assets. But then we took out our loan up top on part of it. We're going to finance all the assets. We took out the part of it of the 960, so minus the 960. So I'm going to double click on this, minus the 960. And that gives us to our 760. So these two add up then to the total assets, which was that $1,720,000. We're going to be financing the complete assets with loans, just breaking them out between short-term and long-term. So then we're going to have the rate then. On the rate, it's going to be equal to the 8% here, 8% on the rate. We're going to go up top, going to go to the Home tab, numbers group, percentify it, then Home tab, font group, and underline it. And that's going to give us our short-term interest expense, which we'll put in the outer column, that being equal to the $760,000 times the 8%. Let's go ahead and underline that one. Home tab, font group, underline. That's going to give us our total interest expense. We're going to sum up the outer column equals the sum of the trusty sum function of the outer numbers. That's going to give us our total of the 176, the 176. All right, now let's do our little income statement, starting with the earnings before interest and taxes, basically net income, before we consider the change that we had here, the interest expense, and then the taxes. So we're going to say earnings before interest and taxes, earnings before interest and taxes is going to be equal to this 530,000. Then we calculated the interest expense up top. We did that right here. That's what we just did. That's the 176,000. That's going to give us the earnings before taxes, which is going to be equal to the 530 minus the 176. Let's put an underline here. Home tab, font group, and underline, and then we're going to calculate the good old taxes, which is the 35%. That's our rate that we're going to be using. This is going to be equal to the earnings before taxes times the 35%. And then we're going to end up with our earnings after taxes, the bottom line, the line at the bottom, what we've been waiting for. This is exciting. It's going to be the 354,000 minus the 123.9. That's going to be the 231. Let's put an underline under the taxes. Home tab, font group, and underline. So there we have our first scenario. Now note, once you start to do this, you can start saying, okay, if I adjust these numbers, if I adjust the rate, or if I start to thinking about different types of financing options for them, then you can use your data to the left to start to copy this over. Another way you could do this is copy the entire thing and pull your numbers over here, so you can see we basically have the same information. So we could do like a side-by-side type of comparison, which is what we'll do now. And the only thing that we're going to be changing in this is this little text data, which says now we're going to plan on financing all the fixed assets, all permanent current assets, and half of the temporary current assets with long-term financing. So we're going to be more aggressive this time, or less aggressive this time, more conservative, you would say, less aggressive. So that means that we're going to say, and the reason I don't like the term conservative is because people construe conservative strangely. So if you see conservative here, it means less risky, typically, is what you're going to be meaning. If you hear conservative, less aggressive, or being less aggressive, I think might be more descriptive for most people, not as confusing sometimes. I don't know. But in any case, that means that we're going to then be having like I say, if you were to break this out like you would think, lining up directly to the short-term and long-term loans to the permanent and temporary, you would think that you would be breaking out the long-term loan to the permanent current assets plus the fixed assets, and then the current temporary assets having the short-term loan. But again, if we want to be more conservative or less aggressive, then we can say that I'm going to take up more with the fixed loan here and lock down the rate and possibly have a longer term on the loan, even though I think that some of this information or some of these assets are temporary and may go away, and therefore the financing might not be needed once that happens. So that's just going to be a judgment call. So we're going to then say, all right, let's just work through this again. We're going to use some of our formatting that we did to the right to make this a little bit easier. So I'm going to make this a little bit easier. We're going to make this worksheet. This will be equal to the current assets. I'm going to then use the autofill to copy that down. So we get those numbers. Then I'm going to format paint this entire thing, selecting this entire box. Home tab, clipboard, format paint. I'm going to put that right in the top blue box because the cells are going to be the same in shape and size. So we're going to be picking that up. Then we're going to say that the current assets, this is just going to be the same calculation, are the 990. The permanent current assets are still the 460. Subtracting those out, the 990 minus the 460 is once again the 530. Then we're going to do the same thing down here for the interest calculation. We're going to be picking up the same names. I'm going to copy and paste. I'm going to use the keyboard this time. Control-C, down arrow, holding Shift, down, 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 down. Control-V. Oh, that was C. I hit C instead of V. Do it again. This time Control-V. And there we have it. Now I'm going to format paint. Going to select this entire area. Home tab, clipboard, format painter. And then just click this top area, and that'll format the entire thing for us. Then we're going to go over and we're going to say that the long-term financing now is going to include all the fixed assets, all the permanent current assets, and then half of the temporary assets. So we're going to say, all right, that's going to be equal to all the fixed assets and all of the permanent current assets, and we have the temporary current assets, but we only need half of that, so I'm going to pick that up times 0.5, half of that. We don't need brackets because of the order of operations. We'll do multiplication first, but it might make sense to just see it visually that we're going to take half of that one plus the other two with the brackets there. And so that's going to give us our 1,455,000 that we're now going to be multiplying times the 12%. 12%. Let's multiply this out in the outer column. This is going to be equal to the 1,455 times the 12%. Then we're going to have the short-term interest expense. Notice I didn't really format this properly over here. We didn't do the formatting. Let's do the formatting both at the same time. I'm going to select these three, and then I'm going to hold down Control on the keyboard and select these three. I've got non-adjacent cells that are now highlighted. They're not next to each other, in other words. Home tab. We're going to go Alignment, increase the indenting. Then I'm going to select this one and this one, holding down Control, this one, and then this one while I'm holding Control, and then Home tab, Alignment, increase the indenting. You can do that one at a time or not at all if you don't want, the fancy formatting. I don't know why you wouldn't, because it's not. But in any case, we're then going to say that this is going to be equal to the short-term portion. So I'm going to take the total assets, which is going to be the current assets plus the fixed assets, minus the amount that we financed up top, which is the 1,455,000. So we're going to finance then the rest with the short term. So the sum of these two then being the total assets at the 1,720,000, as was the sum of these two, still financed at the 1,720,000, simply broken out differently. And now we're going to say that this will be equal to the 8%. So we'll pick up the 8% there, let's say. Multiplying this out, the 265 times the 8% is going to give us the 21,200. Let's go ahead and sum up the interest on the total here then. It's going to be the 174,600 plus the 21,200. That's going to give us the 195,800. Then we'll calculate the bottom portion of our income statement, and starting with the earnings before taxes, I'm just going to pick up the same information on the left. We'll do this a little bit faster. Let's format the entire thing first once again. I'm going to autofill this down. Then I'm going to select this entire box. Home tab, clipboard, use the format painter. Format paint this entire box. And then we're going to be starting with the same number, that being the 530, but now the interest has now changed to be the 195,800, which is more because we used a less aggressive plan, which typically will result in a higher interest rate, but less risk in the future. So then we're going to say this will be the 530 minus the 195,800. And then we're going to be picking up the taxes, which is going to be that earnings before taxes times the tax rate, which is this 35%. Then we're going to subtract out the earnings before taxes minus the taxes, and that's going to give us the earnings after taxes, which once again is a bit lower than it was before, given the fact that we're using a less aggressive plan over here.